Welcome to the Gamma Brief. I'm your host, Alex. If you're new here, the Gamma Brief is an experiment. I'm using a layered generative AI pipeline to reliably capture market data, economic events, and structural mechanics, and then turn all of that into accurate, actionable briefings every day. As always, this is market intelligence, not financial advice. All right, let's get into it. Monday, March 23rd, 7 a.m. Eastern. ES futures are trading at 6,496.5. VIX is rising notably overnight, indicating surging hedging demand beneath the surface as structural supports fail. Friday's sharp risk-off close at 6,506 parked us on the edge of a cliff, and overnight action has already pushed us over. If the breakdown below 6,500 holds into cash open, dealer hedging will aggressively accelerate downside momentum. Here's your regime assessment. The market is operating in an absolute negative gamma regime with a net GEX magnitude of negative $13.3 billion. There is no gamma flip level today. The complex is entirely saturated in negative gamma. In this environment, dealers are short options. To remain delta neutral, they are forced to buy into rallies and sell into dips. This pro-cyclical hedging behavior strips the market of mean reversion, heavily amplifying directional trends and widening intraday ranges. The hard data shows VIX climbing to 30.45 despite relatively muted future action overnight, exposing significant underlying demand for downside protection. Looking at the critical pivots, dealer gamma support has already failed. Spot at 6,496 has breached the 6,500 put wall. The call wall sits far overhead at 6,800. The mathematical geometry of the options market projects a 125-point expected move for the session, which reaches down to 6,371. By trading below 6,500, we are already projecting a full test of this downside range. What drove the overnight action? The market is digesting a toxic mix of stagflation and geopolitical risk. Last week's hotter-than-expected February producer price index, combined with weekend escalation in the Middle East and oil breaching $100 a barrel, has forced broad-based deleveraging. Safe haven liquidation in gold and heavy distribution of U.S. tech futures confirmed that participants are actively taking risk off the table rather than rotating. On the risk radar today, the calendar is relatively light, with the Chicago National Fed Activity Index dropping at 8:30 a.m. Eastern. The calendar risk is 3 out of 5. The primary threat remains headline risk in market mechanics. Given the absolute negative gamma environment, a hotter print that spikes yields will force dealers to sell into weakness, accelerating the drop. Conversely, a soft print could spark a sharp, illiquid short covering bounce as dealers chase the rally. Strategically, the regime demands convexity over income. Range-bound strategies carry outsized tail risk today. The actionable playbook dictates the primary plan as a breakdown expansion. The trigger is a sustained break below the 6,500. The trigger is a sustained break below 6,500, capitalizing on volatility expansion and dealer selling. Express this via put debit spreads like the 6,500 to 6,521 structure on retest failures. The alternative plan is a reversal rally if buyers step in. The trigger is a sustained reclaim above 6,564. If that hits, gap-fill chasers can use the 6,564 to 6,643 bull call spreads, risking a breakdown back below 6,500. Bottom line, the 6,500 put wall is breached and negative $13.3 billion in negative gamma is acting as an accelerant. Stay directional and respect the 6,500 trigger and avoid naked premium selling. The regime wants to move. Position for the break or stay small. Level set, bias defined. Good luck out there. If you want to see more of the Gamma Brief in your daily rotation, hit that subscribe button and don't forget to like. Standard disclaimer applies. This is market intelligence, not financial advice. Derivatives are high risk. Always trade your own plan.